Here's the truth. There's millions of people who are overpaying on their taxes every single year just from the lack of understanding taxes. There are people who miss out on deductions. There are people who miss out on loopholes. And what I want to do is I want to give you 9 basic tax deductions that anybody could qualify for. Whether you're self-employed, whether you're W-2, these are deductions that you want to make sure that you know so you can figure out how to get them incorporated into your tax return. Without further ado, let's dive in. All right, guys, let's jump right in. The standard deduction is the single most important tax deduction that exists for W-2 taxpayers because this deduction is a freebie. It's literally given to you. And guess what? It's a fixed amount that you get to subtract from your taxable income, and it's quite a substantial amount of money that you get to deduct. And it's adjusted for inflation every year. In 2025, it's $15,000 if you're single and $30,000 if you're married filing joint. So if you made $100K in taxable income in 2025, you would be able to use the standard deduction to deduct your taxable bill down to $85,000 if you're single or $70,000 if you're married. But just remember, if you do use the standard deduction, it means that you will not be able to itemize your deduction. So keep that in mind. Now, let's talk about some other great deductions that are available for individuals. One of them being retirement contributions. Retirement accounts don't just help you save for retirement. Many of them also have incredible tax benefits. For example, if you have a traditional 401k through your employer, you can make contributions with pre-tax income. This allows you to reduce your overall taxable income for the year, which will lower your overall tax bill. If you are self-employed and if you don't have an employer to offer you one of these tax plans, then don't worry. There are other retirement accounts, such as the traditional IRA, that provide similar benefits to the 401k, just like with traditional 401ks. Contributions to traditional IRAs allow you to reduce your taxable income, which will lower your tax bill. So whether you're an employee or you're self-employed, there is a retirement account out there for you. And you can also look into setting up your own self-employed 401k plan. Now, let's talk about number 3, charitable donations. Charitable donations are donations that you make to a qualified charitable organization, such as a 501c3. There are a wide array of charitable organizations in America, such as the Salvation Army, the American Red Cross, the St. Jude Children's Research Hospital, and much more. Individuals get a tax deduction for donations made to charities like these and many more. There are different ways to donate to charities. For example, cash and property are 2 common options. The government allows you to write off the value of the cash or the property that you donate to the charity. However, depending on the value of your donation, you may need to get validation from the charity that they received your donation, proving its legitimacy. For 2024, validation was required for cash donations of at least $250. If you donate property and if the property is worth more than $5,000, you will also have to get a qualified appraisal for the property. You will include this appraisal when you file Form 8283 with the IRS for non-cash charitable contributions. Charitable donations are not just a great way to lower your tax bill, but they also can go a long way towards helping people in need. So I highly encourage all of you to donate to charity for tax benefits and for the betterment of society if these are things that you're interested in. All right, let's move on to HSAs, health savings accounts. If you've never heard of a health savings account or an HSA, it's a tax-advantaged account that helps you to save for qualified medical expenses. These accounts are super beneficial because they provide a triple tax benefit. For example, contributions to HSA accounts are tax deductible. You can contribute thousands of dollars per year to these accounts, and this means that you can lower your taxable income by thousands of dollars. Additionally, once the money is inside the account, it can grow tax deferred. And if you withdraw the money to spend it on qualified medical expenses, then you will not owe any taxes on your withdrawals. That creates the third tax benefit. There are many different types of medical expenses that could count as qualified medical expenses, such as an ER visit, a surgery, a doctor's office visit, prescription drugs, insulin, and many more. So please don't overlook the HSA. It's a powerful tool to help you reduce your tax bill and to save for medical expenses that you will have in the future. Which leads me to medical expenses. If you racked up a significant amount of medical expenses during the year, then you may be able to deduct a portion of them. So if you were in the car accident, had a major surgery, it qualified for a medical expense that year, these are medical expenses that you might be able to deduct. There are rules for writing off medical expenses, however. For example, you can only write off qualified medical expenses that are in excess of 7.5% of your adjusted gross income. Also, you will only be allowed to write off the expenses that were not covered by insurance. Let's just say, for example, your adjusted gross income is $100,000. That means that if you had medical expenses of $15K, you would only be able to write off $7,500 because anything in excess of 7.5% of your adjusted gross income would be deemed a qualified deductible expense. This is why medical expenses are super important to track, because when we run your numbers for tax preparation, we're determining if you should take the standard deduction or itemize your expenses. Now, mortgage interest is next. If you bought a home using a mortgage, and if the mortgage is not paid off yet, then you most likely will be able to deduct your mortgage interest. There are some rules that you need to be aware of when it pertains to deducting mortgage interest. For example, if your mortgage was taken out before December 16, 2017, then you can deduct mortgage interest for the first 1 million of your mortgage loan. However, if your mortgage was taken out after December 16, 2017, you can only deduct up to $750,000 of your mortgage loan. These are itemized deductions: medical and dental expenses and mortgage interest. The next itemized deduction is SALT. SALT stands for state and local tax. The SALT deduction allows you to write off certain state and local income and sales tax in addition to property taxes. However, keep in mind that the SALT deduction was capped at $10,000 in the Tax Cuts and Jobs Act of 2017. So there is definitely a limit to the amount of money that you can deduct with this write-off. But during his successful presidential campaign, President Trump vowed to restore the SALT deduction back to its former glory by removing the cap. Apparently, he had a change of heart about this tax deduction. So guys, in the near future, the SALT deduction could be worth a lot more than it currently is and could make more of a difference for your tax savings. Just imagine being able to deduct all of your state taxes. Now, let's talk about student loan interest. If you are someone who is carrying a student loan interest balance, or if you are about to go back to school and take on a student loan to do so, then this is one that you need to know. Right now, you can deduct up to $2,500 in interest paid on qualified student loans each year, even if you don't itemize your deductions. Student loan interest is an above-the-line deduction, meaning it reduces your taxable income and applies regardless of whether you take the standard deduction or itemized deduction. Now, to qualify for the student loan interest deduction, the loan must be a qualified student loan. It must also have been taken out solely to pay for qualified higher education expenses such as your tuition, room and board, you name it. All of these education-related costs are typically what racks up in a student loan. Additionally, you must be legally obligated to pay the loan. This means you must be the borrower or the one on the loan. Interest must be paid on the loan during the tax year, and you can only deduct interest that you've actually paid in a given year, not just the interest that has accrued. Finally, this deduction phases out as your income rises. For example, it starts to phase out once your AGI crosses $85,000. It's crazy, guys. And I believe a lot of these rules do need to change. This brings me to our last write-off for this video: capital losses. Capital losses are losses that generate when you sell a capital asset at a loss, and capital assets includes your stocks, your bonds, and your real estate. However, keep in mind, just like with many other deductions in this list, there's a limit to the amount of capital losses you're able to deduct in a single year, and the limit is $3,000. Sucks, I know. But here's the good part. If you have more than $3,000 in capital losses, you're allowed to carry the excess losses forward and deduct them in a later year. So let's just say that you have $9,000 in capital losses. You could deduct the first $3,000, the additional $6,000 would carry forward to the next year. You'd be able to absorb another $3,000, and then you have another $3,000 rolls over to the next year. Now, as promised, I'm going to answer a question from one of my subscribers. This question was asked by my most recent video, how to avoid these mistakes before starting an LLC video. Check that one out if you haven't seen it. This question was asked by a Sakoto gaming channel. Sorry if I butchered that. The question was, does ordinary income from an LLC get taxed the same as someone who is employed by an organization? If you're employed by an organization, that means that you're a W-2 employee, and that means you're only paying 7.65% into Social Security and Medicare. You will have your taxes being withheld on every paycheck. When you're self-employed and you get paid through an LLC, you're responsible for paying Social Security and Medicare taxes, both the employer and the employee. So that's 7.65% on the employee side, 7.65% on the employer side. So you're paying a total of 15.3%. The benefit of being the business owner is you get paid first, you spend money second, you give money to Uncle Sam third. The downside of being an employee is you make money first, Uncle Sam takes money second, and you spend what's left over. Choose which one you want. Let me know in the comments what you liked about this video. I'll be creating other videos for you to help your tax knowledge. Thank you so much for subscribing to my channel, and I'll see you on the next video. Cheers.